Hi, everyone. Welcome tonight. Just making sure everybody else can get in. Thanks for joining. My name is Debbie Schwartz. I am the founder of Road2College and Paying for College 101. And I'm here tonight with Chris Abkarians, and he's a co-founder of a company called Juno. And we're going to talk about student loans, federal, private. We're also going to share some information about different features when you have to make decisions about loans and how that might impact interest rates that you're offered. And then we're going to talk about Juno and really how it can help you and your student find a loan at the lowest possible interest rate. So this is, I think, the third year, Chris. We've been doing webinars, so this isn't the first time. We've been working together for a while, and Juno has helped a lot of Road2College families. It's helped a lot of families in general. So they have a lot of good information, and I think it's a great opportunity for families to do some shopping of loans and then try and see if they can get an even better interest rate. And we're going to talk about that all tonight. So Chris, I'm going to hand it over to you to start, and then I'm also going to stream this to our Facebook group.
Great. Thank you very much for the intro, Debbie. And before we get started, the webinar is being recorded, and I've got a copy of the slides that we'll walk through, as well as some of the links that we're going to discuss tonight in your inbox later. So if for any reason you have to hop off early, please don't worry. You'll still get everything sent to you over email. If you have any questions as we go through any of the slides, please feel free to use the chat box in Zoom, and we'll stop periodically on each slide and see if there's anything relevant to answer there. If not, I'll save as much time as possible at the end to answer more detailed questions that we might not have been able to get to during the presentation. With that, quick intro on myself and why I'm here. As Debbie mentioned, we've been working together for the last 3 years on different types of webinars. And my journey with student loans started a bit longer ago than that. About 5 years ago, I'm going to tell you just a really quick story. One of my friends and I were going to business school together, and we had to figure out how to pay for it. So we started comparing what different loan rates were out there for us. We started logging what rates we qualified for from a lot of different lenders. And then he brought up an idea of trying to negotiate the rates that people were eligible to get by bringing a group instead of an individual. So what we did was we bundled together a few hundred people who needed to get student loans for really just our classmates and their friends. And then we reached out to a bunch of different banks and credit unions and asked if they would provide better rates and terms to the group than we would get on our own. And a bunch of them said yes. And then Juno was born. Since then, we've been fortunate to grow the concept from about 500 students and 10 schools to 130,000 students and families and schools all across the US and Europe. And so with that, I will just jump into the agenda for what we'll talk about for the next 30 to 45 minutes. So step one, we're going to spend a bulk of this presentation talking about how undergrad student loans work. We're going to cover the 2 types of federal student loan programs that you should know about, as well as some key things to understand about how private loans work. Second, we're going to talk about how to think about comparing private student loans versus a Parent Plus loan. So in the first section, we'll have a decision tree that'll help you think about the pros and cons of different loan types. In the second portion of the presentation, we'll provide you with a calculator that helps you figure out the answer for yourself, and I'll walk you through step by step exactly how to use it. And then the third section of the presentation will be brief, but it's just a little bit more about Juno, what we're able to offer to parents and students this summer, and then we'll leave as much time as possible for Q&A. So the first thing that we're going to talk about is how undergrad student loans work. And in general, you can think of it this way. There's 3 broad buckets of ways that you can get student loans to pay for undergrad. 2 of them are federal student loans, and the third is private student loans. We're going to go through each of these 3 programs in a lot of detail over the next 10 to 15 minutes. For each program, I'm going to provide you with a 2-slide cheat sheet that covers a lot of the main things that you should understand, like how much a loan costs, when you have to start making payments, how you qualify. So I won't go into a lot of detail here on exactly what these things are, but let's just dive into what is most frequently called the best student loan program that exists, which is a federal direct loan. And I apologize for 1 second, but before we dive in there, we're going to talk about 8 key things that you should know about each type of loan program. 4 of these things are directly tied to how much you're going to pay. So we're going to talk about whether there is an origination fee for a loan, what the interest rates are, how much you can borrow through it, otherwise called a borrowing cap, what type of rate it is, whether it's fixed or variable. We're also going to talk about how you qualify, whose name the loan is legally in, when you have to start making payments back on the loan, and what happens if you face any sort of economic difficulty or financial hardship after graduation. Some programs have protections, some don't. So the first loan program that we'll talk about is the federal direct loan. If you ask any financial aid advisor, they would tell you that if you need to take a loan to pay for college, this is where to start. And the primary reasons why are that it is among the cheapest options that are out there, and it has by far the most protections in place in case anything happens to the student after graduation. Let's walk through some of the key things to know about this program, and then I'll talk about a few additional things that you should know. So first off, all federal student loans have an origination fee. In the case of the federal direct loan, the origination fee is rather low. It's a little bit over 1%. The way it works is not that you have to pay 1% of the loan amount to the government to take out the loan, but instead you have to borrow a little bit more than what you have to pay to the school in order for the school to receive what they need to get. Let me use a really quick example to make this simpler. A 1% origination fee here means that if you had to pay, to use an example, $100 to UCLA for the fall, you would actually have to borrow $101.06 from the Department of Education in order for UCLA to receive $100. So just know that that's generally how an origination fee works. It just means the amount that you borrow has to be a bit larger than the amount that you have to actually pay to the school. The interest rate on,
sorry, Chris, the only reason that I'm going to jump in, the reason why that's also important, and I've just seen it with families, is that when they are trying to figure out, what they're going to have to pay, what they're borrowing, sometimes they just assume, oh, the full $5,500 is going to go against my student's bill. And so, and it's the same situation if you end up doing a Parent Plus loan, anything that has an origination fee, you can't use the full amount and assume that that's going to go against the bill. So that's why people kind of get flustered when they see, oh, it's off and I'm owing a little bit more than I thought I was going to owe, or, that the loan didn't cover it all.
Yeah, fantastic point. And thanks for bringing it up. So the interest rate on federal direct loans is 5.5% fixed for all new loans that people are taking out. That 5.5% number is candidly very low compared to what you'll find on the market today from anywhere else. There's not a traditional credit check required in order to access a federal direct loan. You just have to be a student attending college in the United States. And so as a result, the loan is only in the name of the student borrowing it. This isn't something that requires a co-borrower. The parent can't even be legally attached to this loan. This is something that the student just takes out for themselves. And they don't have to start making any payments on this until 6 months after they graduate. One of the best things about federal direct loans is that they have a lot of hardship protections built in. So say your student graduates and it's 6 months after they've graduated and they haven't landed a job, or they've landed a job that pays a lot less than they expected to make. This federal direct loan would allow them to limit the amount they have to pay each month to a very low percentage of their discretionary income. And if they're not making any money, then they don't have to make any payments at all. They'll still be accruing interest, but they can delay making payments until they're able to afford them again. Additionally, if you end up working in a nonprofit setting, or let's say you become a teacher, then you can get public student loan forgiveness. So after working in that setting for 10 years, this federal direct loan can be completely wiped away. So those features do make this, in many ways, the best place to start. The downside of a federal direct loan is simply the amount that you can borrow through it. So for the first year, you can borrow $5,500. For the second, third, and fourth year of school, what you can see on this slide is a chart from the Department of Education that lays out exactly how much you can borrow by year. Now, let's go into a few key things to note here. What you see on the left-hand side is a column for dependent students. The vast majority of students fall under this classification, meaning they can borrow $5,500 a year for their first year, $6,500, and then $7,500 for their second, third, and fourth year of school. You can borrow more money through this program if you're classified as an independent student, which means that you meet some of the criteria that the Department of Education lays out on the right-hand side of the slide. So if your student is at least 24 or married, an orphan or a ward of the court, a veteran, an emancipated minor, all of those things are reasons why the Department of Education would classify them as an independent student and allow them to borrow more money through this program each year. I'll pause there if we have.
There's actually, yeah, there's a good question, Chris. And somebody is asking, does the interest rate change every year? And maybe along with providing that answer, you can explain how the interest rate for these loans are determined.
Yeah, fantastic question. Short answer, yes. The interest rate changes once you take a loan and the money is sent to the school. The interest rate will not change between the day that you've actually taken a loan and the day that you pay it off. But if you wanted to get a Parent Plus loan this year, and then let's say you use a Parent Plus loan to pay for the second year of school, the rate on that second loan will likely be different than what you're paying for the first one. The reason why is around 2012, Congress overhauled the federal student loan system. And they came up with a formula that determines exactly how federal student loans are priced. I can go into it in detail, but I'll just give the super high level version. The formula works like this. They take the 10-year treasury rate. So whatever the 10-year treasury is trading at on a specific day in the month of May, and then they just tack on a few percent to that that's defined in law. And so each year at some point in May, the government looks at the cost of a 10-year treasury, and then they automatically add a certain number on top of it. That number is different for each type of federal student loan. And then that sets the new rate for all federal loans that are taken out for the next year.
So that's the rate. I mean, they're two separate rates, but that's the process that sets the rate for the student federal loans and the Parent Plus loan.
Yes, exactly.
And so in essence, that happens every year. So every year, if your student's borrowing the federal direct, or if you're borrowing the Parent Plus loan, it is technically a new loan, and it technically has a different interest rate. So your student graduates if they're borrowing every year with a minimum of 4 loans, that are from the government, direct loans. And then if you're borrowing every year, whether for Parent Plus loan, and even a private loan, each year it's a separate loan.
Exactly. And just to bring that example back to the federal direct loan, I told you that this year federal direct loans cost 5.5%. Last year it was 4.99%. So it just gives you some sense for what the movement looks like.
And another good question is this idea of if I don't take the full amount, or if I don't take a loan 1 year, can I carry over the money they didn't borrow in 1 year to the next?
It's a great question, and unfortunately, it's a simple no. You have to use the amount that you're eligible for in that year. If you didn't use the $5,500 this year, you're still capped at the $6,500 for next year.
So there's a question, maybe just to clarify this. So somebody's asking to take the $5,500 loan, would I need to borrow roughly like $5,800 to cover the origination fee? So maybe you just want to stress that or restate how that works.
Yeah, and thanks for the question. So the origination fee is small on the federal direct loan, but yes, you'd have to take 100 and let's say 1.01 times 5,500. So it's going to be $5,610 roughly. Will be your starting principal balance, and $5,500 will go to the school. Or did I do that math wrong? Be $5,560. Yeah.
And there was a question earlier, I scrolled over for a second. About if somebody wants to go to graduate school after finishing undergraduate, can they continue to postpone the repayments or starting of the repayment for the undergraduate?
It's a great question that varies depending on the loan type. So for federal direct loans, you can defer up through post-secondary education, but for private loans, you can't.
Which is an interesting, that's like another kind of in the plus versus minus column of making that decision.
Let's see, do we have any more questions you think we should go through here, or?
Yeah, I think we might need to clarify, Chris. I also thought that the $5,500 is the max.
Yeah.
So if they're taking, so the origination fee, it's what goes to the school is $5,500 minus the origination fee.
Yes, yeah. For the first year, exactly. So the school you could use this to pay the school roughly around $5,450.
Right.
Got it. Okay. I think this is a good point to bring us to the first leg of a decision tree. Because when you're thinking about paying for college and thinking about how to use student loans, it's important to understand that you can mix and match different types of loans together. And what you want to do is try to use the cheapest loans first up until you hit a cap on how much you can borrow, and then move on to more and more expensive loans so that you minimize the overall cost by the time you pay it off. And the simplest point of the decision tree is the first one, which is to say that if you're in the fortunate position of not needing more than $5,500 to pay for freshman year, then you should just use the federal direct loan and feel free to ignore the rest of this presentation and the other loan programs, because that is really the program that you should start with. If you do need more than that $5,500 number, then I'd say don't worry, because a lot of people do. And that's part of why the federal government created a second loan product called Parent Plus that we'll walk through in just a minute. I'm seeing a few questions that are popping up on the right. Let me just make sure there's nothing we should answer really quickly before we move on and talk about Parent Plus.
Well, actually, I was responding to an email, but maybe we should just explain it. Somebody was asking and trying to understand. We talked about that students and parents might end up with multiple loans, and they were wondering if we meant that if do they have to take out a loan for first semester and second semester? So to maybe just explain, it's really one loan, but multiple disbursements.
Yeah, exactly. So when you take out a loan for the full year, say you took out let's use $5,000 as the example. 2,500 of that is sent in the fall. Another $2,500 is sent in the spring. But it will still show up as one loan on your credit report and one place you have to make payments to after graduation for that loan. All right, we're gonna go through exactly what we just did, but for something called the Federal Parent Plus. So the big difference between this and the last program that we looked at is, one, this is only available in the name of the parent. So the parent has to borrow this on behalf of the student, but the student isn't legally tied to the loan. Two, it's quite a bit more expensive. And three, there's fewer protections involved than what we saw in the last loan program, although there still are some. Let's run through the key things to know. And then I have another slide I'd like to share with some considerations for how I like to think about Parent Plus. So in the last program, we were talking about origination fees. The 1% origination fee isn't that massive, but the Parent Plus loan has a significantly higher origination fee at 4.23%. So to use the same example, or let's use the revised example that we had. If you borrowed $100, then UCLA would only receive $95.80. So that 4% origination fee on Parent Plus really starts to add up. It's also quite a bit more expensive on the rate itself. Before, we showed you that on the federal direct loan, everybody gets a 5.5% fixed rate, no matter what your credit is. On a Parent Plus loan, the rate is 8.05% fixed. And so that's a pretty significant jump, but that's just because of how Congress has defined the formula that sets these rates. Students get to borrow for lower, parents get to or have to pay more in order to borrow. There's not a traditional credit check that's involved to access a Parent Plus loan, although on the next slide, I am going to talk about some of the reasons why you might get denied access to it. And almost forgot to touch on this. Two more things really quickly. One, unlike the last loan program we looked at, you're allowed to borrow all the way up to the cost of attendance for a Parent Plus loan. Cost of attendance is a term I'll use a few times, and what it simply means is the sticker price to attend the school, accounting for everything that you might have to spend money on. So every school's financial aid website publishes something called the cost of attendance, and it includes tuition, mandatory fees, an allowance for housing and food, and some allowance for personal living expenses. That number is the maximum that anyone is legally allowed to borrow through either a federal or a private student loan. And so when you hit the cap on a federal direct loan, you should know that the Parent Plus loan is there to help you fill the gap between what you can get through that program and whatever it is that you actually have to pay directly to the school. Last two things that are important to know here. There's a button you have to click in the Parent Plus application that defines when you're supposed to start making payments. By default, you are supposed to start making payments about 60 days after the money is sent to the school, which another way of saying when the money is dispersed. But you can choose to delay making any payments on a Parent Plus loan until 6 months after the student graduates. You just have to opt into it. A lot of people will go through this part of the process quickly or might not remember what they selected. If you're unsure and you want to defer making payments until after graduation, then my recommendation would be to just email the financial aid office now. The sooner the better, because they are starting to get very busy. And just let them know that you want to check if you've opted into deferring payments until after graduation. And if not, ask them to help you do so. All right, this is our last slide on Parent Plus. for right now, and then there's a few more things that we're going to touch on later. So put simply, who's eligible for Parent Plus is only parents of undergraduate students who are enrolled at least half-time in school. So it's just really important to know that children can't get this loan in their own name. It doesn't show up on their credit report. They're not legally responsible for it. And so whatever agreement you'd want to make about shared burden and responsibility to pay back a Parent Plus loan just has to happen offline as a conversation between you and your children, if that is something that's important to you here. Otherwise, there are scenarios I've seen where students were unaware that their parent even took out a Parent Plus loan because it doesn't show up on their credit report and they don't know that it exists. So if this is something that you want them to help you with, I just recommend letting them know that it exists and talking to them about it now instead of after they graduate. How you apply for a Parent Plus loan is also really important. So first, you have to have completed FAFSA. We're not talking about FAFSA a lot tonight because we're assuming that everybody has already filled it out, but if you haven't yet, please do so. And then once you fill that out, there is a Parent Plus application that you get access to. Some schools have you apply through a dashboard on the school's website. Some direct you to the Department of Education's website that has the application on it. And in that application flow, let's say you submit it. If for whatever reason you've been denied, that's the last step that we should talk about. As I mentioned before, there's not a traditional credit check for a Parent Plus loan. So you could have 580 or an 800 and everybody gets the same 8.05% fixed rate. But there are a few reasons why the Department of Education states that it might deny somebody access to a Parent Plus loan. And those really are as follows. If you've had a recent bankruptcy, a large debt that's more than 90 days liquid, or a recent wage garnishment or a tax lien, those are all reasons why the federal government might deny you access. If that happens, there is one really important tip that you should know, and it's that I'm going to scroll back up a few slides. If you've been denied access to a Parent Plus loan, then you can request that your student is now allowed to borrow the independent student limit on a federal direct loan. So if you were denied and let's say there's no way to fix it and to get access to Parent Plus, then tell the financial aid office that you want the student to be classified as independent for the purpose of the federal direct loan. And then they'll be able to borrow $9,500 for the first year and $11,500 for the second year. All right, I'm going to pause there because I think we just went through a lot on Parent Plus.
Maybe you could just go over again, where do you apply for the federal? Well, this is actually a question back to the applying for the federal student loans.
Where you apply for the federal direct loan?
Yes.
Good question. So just make sure you filled out FAFSA and your school's financial aid application. And typically that's all you need to do. The school sends, so typically there's instructions within so school sends you back your financial aid award letter. It typically has a login. And when you log in to view your financial aid award letter, it will typically have a link to opting in to use the federal direct loan if that's something that you want to use.
So it's usually through the portal that your student, is going to get a login to as part of like the financial aid account that they're going to have with the school.
Exactly.
And then there's a question about, is there a maximum time allowed to pay back the federal loans? That's a good question. I don't think we really went over that.
Great question with a complicated answer. Let me start simple. The standard repayment expectation is 10 years. And so when you look at all federal loans, if you make the required payments in a standard repayment plan, you'll be done paying it off 10 years after you start making payments. So if you, and let's get a little bit more specific on that. If your student is an incoming freshman and you defer making payments until 6 months after they graduate, you'll be done making payments 14 and a half years from now, because they'll be in school for 4 years while payments aren't being made. You might avoid making payments for 6 months after they graduate, and then there's a 10-year window at the end of it during which you should be done paying it off. If you choose to enroll in some of so the federal government has a lot of different repayment plans for student loans, and some of those are actually changing right now, and we'll know more in the next couple of months about what they look like. But if you did one of the programs that lets you limit the amount that you pay each month to a percentage of your income, then it's possible that you might take a lot longer than 10 years to pay it off, sometimes 20, even 25 years. Good question from Ruth on, the question is, are there penalties for paying loans back early? Answer is no. So no federal loans have any prepayment penalties at all. And almost all private loans similarly have no prepayment penalty. I can't speak universally, but I can say that any of the companies that we've ever worked with and that Debbie's ever worked with don't have prepayment penalties.
And let me just emphasize a little bit about this idea about, paying back the loan early, and kind of coupling that concept with the fact that your student can only borrow a certain amount each year, and if they don't borrow 1 year, they can't use that money in another year. It's really important, particularly for the families that are here now. I'm assuming most of you have students that are going to start in the fall, or maybe even start next month in August. You should really try and make a 4-year plan to look at whatever money you have to pay towards college, how much your student's going to borrow in each year, and then what's left over that you need to figure out other sources to borrow from, whether it's the Parent Plus loan or a private loan. And the reason to kind of look at all the 4 years is you might decide that you want to use more of your savings earlier and postpone doing some borrowing till later. But if you plan out the 4 years, you can kind of fool around with those numbers. Something else to think about is parents have asked this. Can I, we sometimes encourage, if you're kind of not sure what money you might have available to pay, in the coming years, whether it's, sophomore through senior year, your student, you can take out the $5,500 this year. If something, happens where you end up having more funds than you thought, they can go back and pay that off early. But at least you've had the security to know that they've taken out that $5,500 to kind of give you a little leeway, not knowing whether or not you might be able to pay it back. So, but once the freshman year finishes, they can't take that $5,500. So that's why sometimes parents just have the student take it, and they might end up paying it off sometime during the 4 years that they're there. So just ideas to think about. Yes, and somebody said, sorry, absolutely plan on tuition increases when you do this 4-year spreadsheet I'm talking about. Honestly, Sandy, I actually, to be on the more conservative side, recommend a 5% increase every year in terms of tuition.
Yeah, Sandy, the average annual increase on I think it's the top 500 largest colleges over the last 20 years has been 6% a year. It's been slowing down a tiny bit, but yeah, the 5-6% is probably what I would use. Okay, there's a quick question here from Monet on if you hypothetically graduate without a job, can you get an extension? So technically, yes, but what you would want to do is enroll in something called income contingent repayment or income-based repayment. And what that does is Basically, when you graduate, your loan is managed by what's called a service. And so you'll have a portal that you log into. And in that portal, you'll be able to select what type of repayment plan you want to enroll in. And if you don't have a job and you don't have income, then you're probably going to want to enroll in income-based repayment. And then there's a basic process you go through to verify your income. If you don't have a job and you don't have income, then you can have your payments set to 0.
Somebody is asking a question, which is a good question. I've been emphasizing, you might want to take the full amount for students. And there's a question of can they take less than 5,500? And you absolutely can. And the other question is, if your student has been offered a part of the amount as subsidized versus unsubsidized, they can just take the subsidized amount. They don't have to take the unsubsidized. You don't have to take the full amount.
Yeah. We haven't spoken about unsubsidized or subsidized loans, but just the really simple version of it is, if you remember the federal direct loan program that we've been talking about, that lets you borrow up to $5,500 for the first year. If after you fill out FAFSA and your financial aid application, the financial aid office might say that you have high economic need, or like a lot of financial need. And if they do, then some of the loans that you can get through the federal direct program can be called subsidized, which means that if you borrow $5,500 on day one, you'll only owe $5,500 when you graduate. The government covers the interest charge while you're enrolled in school. Most people don't get it, but if you do get it, it just means that the loan is effectively interest-free until you graduate, and then it will start accruing interest.
Another question, if you do start making payments on the loan, like in college, do you have to continue making the payments, or can you kind of like stop and go?
For Parent Plus or for
federal, direct, direct.
Got it. If you choose to make, so for federal direct, you don't have to make any payments until 6 months after graduation. If you started making payments early, just because, say, you want to pay off the interest because you can, and then you stopped making payments, that's totally fine. Your only obligation on that loan starts 6 months after graduation. That's the point at which you're going to have to start making consistent monthly payments.
So Sarah has a really good question. If a parent code signs for a student's private loan, does it affect the parent's credits?
This is a great question. And the short answer is yes, but by how much depends on your credit history and basically how long you've had credit, how many accounts you have open, how much this one new thing impacts the overall picture.
So Chris, I don't think you should stop talk about this now, but just I think in the next 20 minutes, there were a lot of questions earlier on, I think it was more in the chat about state loans. So I know it's going to come up when you talk about like Juno, but maybe we could just talk a little bit about what are state loans and, can people get them or not?
Yeah. How about this? Let's touch on state loans for 30 seconds, and then let's try to get through the next section just so that we stay on time. But these are fantastic questions and love the engagement. So state loans are, honestly, in my opinion, amazing. Some states set up programs where they have a nonprofit affiliated lender who's able to provide really cheap student loans, in some cases only to residents of that state, in some cases to anybody from any state. So some of the bigger ones are MIFA, which is the Massachusetts Educational Financing Authority. Anybody can get a loan from there going to any school in any state, and they're a nonprofit lender. There's a couple of others out there. My personal favorite is the one that we've partnered with called Brazos. And so if you are a Texas resident going to school in any other state, to be a Texas resident just means you have a Texas ID. Or if you're any state resident going to college in Texas, then you get to access incredibly low rates from a nonprofit called Brazos. As of this morning, the range is 2.77 to 6.96%. And so as long as you qualify for it, this is a state lending option that is always cheaper than Parent Plus and by a pretty good margin.
So, and this came up earlier in the chat. I don't know, I mean, and we can talk about what your recommendation is. I gave the recommendation, quite honestly, that even if you can have access to the state loans, as a student, I would still take out the federal direct loans and then after go towards the state loans.
Absolutely correct. If there's one thing that that people would remember after this, it would be no matter if you need loans, no matter what type of loans you need, start with the federal direct loan, because even if you might find some other option that's slightly cheaper than that federal direct rate, you don't know what job you might have after graduation and whether that loan might just get forgiven completely and not have to be paid back. And no other program has the benefits in place if you're unable to afford making your payments after graduation. Or let's say you have a child or you start a company and you want to have more flexibility on your payments for some period. That federal direct loan gives you that flexibility. Other loan programs do not. I'm going to move on through private loans just for a few minutes, and then we'll go through the comparison tool. Should be done with all of that in about 10 to 12 minutes, and then we can go back to questions. Is that all right? All right. So I just want you to understand the structure of how the private loan market works. I'm going to go through this for 3 or 4 slides because we end up in a situation where in this decision tree for student loans, you use the federal direct loan, and then for the amount that you need left over, what you should do is compare what rates you might qualify for in the private market versus what you can get through Parent Plus. So the biggest difference for the private market versus Parent Plus is that the rate you qualify for is going to change depending on your credit. So I can't sit here and tell you exactly what rate you might get. But if you have really good credit, then you'll probably qualify for much lower rates. If you don't have great credit, then you probably won't get a rate that's better than Parent Plus. So let's walk through the key things to know about it, and then we'll try to breeze through a few of the slides here. Private loans typically don't have an origination fee. None of the companies that Juno has ever partnered with have an origination fee. As I mentioned, the rate's going to vary. And similar to a Parent Plus loan, you're allowed to borrow up to the cost of attendance, so that full sticker price of the school. All federal loans are fixed. Private loans can be either variable or fixed. We're going to touch on that in 2 slides and why it's important. And you typically need at least a 650 FICO in order to qualify for any private loans. But you really want to be well north of that in order to qualify for the best rates. Last few things on this. Most private loans, well over 98% of them, are in the name of both the student and the parent. So the student is the borrower and the parent is a co-signer. That's the general structure for how it works. The price of the loan, the rate that you get, is almost always going to be driven by the credit score of the parent, since the student typically doesn't really have much credit history. And when you have to start making payments, varies. We're going to, in 2 slides from now, talk about the different options you have to choose when you start making payments on private loans. Now, why would anybody consider a private loan is a very good and very fair question. Let's start with when you'd consider one. We've already touched on that, and that's only after the student has used the federal direct loan. Now, once that's been capped out, then you should be comparing what a private student loan might cost versus a Parent Plus loan. If you end up qualifying for lower rates through the private market than you can get for Parent Plus, then you should at least consider it. There's also a group of people who simply want to make sure that both the parent and the student are legally on the loan document, that they do legally have shared responsibility to pay back this loan. And because you can't achieve that through Parent Plus, some people use that as a reason to explore private loan rates. So we're going to touch on a very important topic around how to understand the private loan rates that you see when you check your rates anywhere. And then I'm going to walk you through, just for 3 minutes, a tool that we built that will help you do this for yourselves offline. So earlier I was mentioning that private student loan rates can vary depending on a couple of things. So they'll vary based on your credit score, but they'll also vary depending on whether you're looking for a loan that needs to be paid off in 5 years or 10 years or 15 years. And I'm going to show you exactly how. They'll vary if you choose, when you choose to start making repayments. And the 4 options that you generally have for when to start making payments are listed on this slide. So immediate repayment means that you're going to make full payments the moment the money is sent to the school. If you were going to UCLA in September and you used a private loan with immediate repayments and a 5-year term, 5 years from this September, you would be done paying it off because you have to make full payments while you're in school. Very few people choose that, but you should just know that that's what that option is when you're doing research on loans. The second option is called interest only, exactly what it sounds like. You only have to pay the interest on the loan while you're in school. A lot of people like this because it means that the amount that they owe when they graduate is the same as the amount they borrowed on day one. And so it's a bit more manageable. And then the third option is called min pay or fixed pay. It's a pretty interesting option that lets you pay a small amount while the student's in school, say $25 a month or $50 a month. But what it allows you to do is enroll in auto pay. So you get to hook up your bank account to the loan provider. And the moment you do that and start making these minimum payments, then the loan provider reduces the interest rate on your loans by 0.25%, which is great. And the final option, which tends to be the most common, is deferred payments, which means you don't have to make any payments until either 6 or 9 months after graduation. And then finally, I think it makes sense, similar to a mortgage, fixed rates and variable rates are just priced differently. So I say all this because one of the things we advocate strongly is to shop around and check your rates at multiple places to understand what you might qualify for. But when you shop around, you should pay very close attention to these 3 things. You're going to see a long list of rates that typically get shown to you. Some of it gets a bit confusing to understand. Just know that these are the 3 levers that impact the rates that you're seeing on a page. I'm going to just spend 1 minute talking about how exactly that gets impacted. And the example I'm showing here is not from Juno's lending partner. It's from a nationwide bank that publishes some of this information online. Most of the time when you're shopping around, if you Google best private student loans, what you're going to see is something that looks like the left-hand side of this chart. You'll see an advertised range that says something like 4.5% to 15%. Or you're just going to see something that says rates starting at 4.49%. Everybody advertises in the same way. They're all going to show you that same thing. But this lender provided some additional information that lets me show you how the factors we just spoke about impact the rate that you're likely going to get. So the first two things I just want to show you is, if you look at the right-hand side here, what you'll notice is in order to qualify for the 4.49% rate, you have to be selecting a 5-year term. And the longer the term length, the higher the starting rate gets. So if you wanted to make the payments back over 7 years, then the lowest possible rate that you can get from this lender is 8.11. And it goes up depending on if you want to take longer in order to pay off the loan. So just lesson one, the longer the term you select, the higher the rate is going to be. Now,
Chris, sorry, do
yeah.
you mind? Though one thing I'll just say this to keep this in mind for everything that Chris is going through is that if you're the lender, they obviously want to get paid back as fast as possible. So they are always evaluating the risk. So so just keep that in mind. That's really the overarching umbrella concept that's driving all of this. So the riskier you become as a borrower, the more interest rate, the higher the interest rate is that they're going to charge you. So that's why Chris was showing the example at 4.49%, that person is saying, I'm going to pay that loan back in 5 years. That's the shortest amount of time that they can pay it back. So that's basically saying to the lender, I'm going to be the least riskiest borrower. I'm not going to have as much risk as the borrower who's going to say, I'm going to take 10 years to pay it back. So just that's like the general concept that underlies all of this.
Yep. Thank you very much for that overview. I'll just zoom in on this, the 5-year chart that shows you 4.49 to 14.3% right now, just to show you one more principle to understand. So, so this is just the zoomed in version of it on the left-hand side. Again, what you'll see is if we're looking only at 5-year fixed rates, the lowest rate, in order to get that lowest rate, you'd have to select immediate repayment, which is exactly in line with what Debbie just mentioned. If you start making payments immediately, it's less risky. The lender can better predict the likelihood of you paying back the loan and when you're going to pay it back. Whereas some of the other terms are quite a bit more expensive than immediate repayment, because the lender, for the most part, isn't going to start getting significant payments until much later in the process. So in general, you're going to see, when you do rate shopping, you'll see a lot of different options out there. But when you see a really low starting number, just know that it's typically going to be a 5-year term, and it's typically going to require you to start making payments immediately. You pause there for a moment. I see a lot of questions here.
Let's see. There was a lot of information, people asking about the state loans. A question about if I can't pay back my federal direct loans right away and have to get an extension, will it affect my credits?
Okay. I'm gonna instead just spend the next 7-8 minutes to finish this up, just so that we can let people go who might not have questions, and then we'll come back.
Okay.
So this is gonna be pretty quick. When you do rate shopping, you're gonna have a lot of different numbers thrown at you. Sorry to complicate things, but I wanted to show you one more. And so when you check your rates with different private lenders, you're typically being quoted back an APR. The APR is similar to a mortgage. It's the true cost of that loan over time. And the problem with that is that the Parent Plus number that I talked to you about was an interest rate. So when we said Parent Plus costs 8%, 8.05% plus a 4% origination fee, we should translate that to an APR before we compare private student loans against it. And so all this slide is just showing you, before you start comparing your private options versus your Parent Plus option, just keep this chart in mind, because this is the true number that you should compare against. Now, the APR of a Parent Plus loan This might be a little bit confusing, but it's different depending on how many years a student has left in school. If a student has 4 years left in school, the real number you want to look at is 8.16%. If it's their final year of school, the real number you want to look at is 8.89%. So just keep that in mind. We're going to send you a link to this, and I'm going to just run through this in the next few slides. But we've created a calculator that's meant to help you enter any private student loan option that you have and understand whether it's cheaper or more expensive than a Parent Plus loan, and by how much. So all you got to do is go to this link. We'll send you the link. And I'll just walk through the 7 steps in 1 minute and answer any questions about it. So you're going to get to a page that looks like this. You only have to enter a few things. You start with entering the loan amount of whatever private loan you're looking at. You'll enter the rate that they're charging you. Third, you'll enter how many years of school are left for your student. So if they're incoming, just put 4 here. Fourth, you're going to enter the term. So if the loan that you're looking at is a 10-year loan, put 10. If it's 5-year, put 5. We just walked through the repayment types. So in this section, there's a drop down. You can select, am I comparing Parent Plus against a loan that requires deferred payments, immediate repayments, whatever it is. And then finally, all you have to do is enter how many months of grace exist for the loan that you're looking at. Most of the loans that people get through Juno and our partners have a 9-month grace period. Most other lenders have a 6-month grace period. Once you enter these things, then you just look at the bottom right-hand side of this page, and it will spell out for you clearly what the difference is in dollars and what the difference is in APR between whatever private option you're looking at and whatever federal loan option you're looking at. Good question here from Mavin on how you'd compare a variable rate loan. Unfortunately, you can't easily compare the cost of a variable rate loan to a federal loan because you have to make a prediction on how the underlying metric that drives the variable loan is going to change over time. We've tried doing that before, and it's just very inaccurate. So I wouldn't want to bring that back again. Mrs. Myers, there is a link to access this comparison tool that will come through in the email that you get, along with the copy of the presentation. And if you have any questions about the tool or you want somebody to hop on Zoom and walk you through it, you can always book time with somebody on my team just by emailing hello@joinjuno.com. And there's multiple people on our team who will more than happily hop on Zoom and walk through an example one-on-one. And thank you very much for sharing the link. All right, I'm going to just go through the last section. So it's only take 2 minutes, and we're going to turn it back over to Q&A. We started Juno 5 years ago to help students and families better understand how to navigate the complexities of paying for college. And as you've probably been able to see over the last hour, it can get kind of complicated, and there's still more that we could get into if we had more time. I want to simplify it, and we've tried really hard to create compelling products that take the guesswork out of this process. So what we've been fortunate to bring to the market this summer is really the following. If you go to joinjuno.com and sign up, and there's a link that Debbie has emailed before and will email again, what you'll end up seeing is what you see on this screen, which is the offer that we've been able to put together for people after negotiating with lenders on behalf of about 100,000 students and families. When you create your account, which is an extremely quick and free process, you'll be presented with the option to check your rates with the lender who won our business. And if you end up using a loan through that lender, then we'll pay you 2% cash back of the loan amount. Meaning if you took out a $20,000 loan, we would cut you a check for $400. If you find a better rate somewhere else, and it's something I'm excited about, we're able to match that lower rate from the very long list of eligible lenders and increase your cash back payout from 2% to 3%. So if you like what you see when you click the button and you use it, we give you 2%. If you don't like what you see because you found something better, I'll walk you through on the next slide how, but you let us know, we get it matched and we increase your cash back to 3%. I'm hoping that this simplifies the process enough, but our goal here is to make sure that this is a no-brainer, that if you consider a private student loan, you would at least check out the offering that we've put in front of folks. And if you find a better rate somewhere else, you'd give us a shot to try to match it and beat it.
So Chris, what about if somebody may at this point have accepted a loan from a lender, but obviously nothing's been dispersed?
Yeah, fantastic question. So if you've accepted a loan that's not yet been dispersed, first off, you are allowed to cancel that loan before disbursement with no penalty whatsoever. Second, if you've already signed a loan, you can still check what rates you might be eligible for from another lender. And so what I would recommend is don't touch the existing loan yet. First, apply for and get approved for a lower rate from another lender before you do anything. Because once you apply and once you get approved, those rates are locked in for 30 days. And now it's safe for you to cancel the old loan. If you cancel the old loan before you've been approved for a new cheaper loan, then it's possible that you might not end up qualifying for a cheaper rate and you canceled it for no reason.
So the reason why I brought that up is whether you've already found the loan, because in most cases, the tuition bills haven't really come yet, the money hasn't gone out. You still have the opportunity to work through Juno and see if their partner can at a minimum match it, and you would still be better off and potentially beat it.
Absolutely right. Yep. And that's a great segue just to talking a little bit more about how the rate match process works. Look, I will say step one of exploring private student loans is to shop around. I'm confident that we found a partner who can put low rates in front of people, but you shouldn't trust me and you shouldn't trust anybody else. It's something you should verify on your own. So step one, please do shop around. There is a website you can go to called credible.com, whose name is on here, that lets you quickly check what rates you might be eligible for from 7 to 8 different lenders without having to do a hard check on your credit. So you can do what's called a pre-qual soft check. You enter some basic information and you see a wide range of what might be available to you. I'll give you some sense for how, say, what the lowest rate is that you're likely eligible for. Next, I'd recommend, if you'd like to, check a few other places that might not be on Credible. But before you end up signing something, before you end up finalizing your process, check your rates with Earnest using Juno's link. This is really important to remember. You have to use the Juno link in order for us to be able to process a rate match request. So after you do whatever shopping around you do, make sure you have a Juno account, that you click the button to check your rates with Earnest using our link, and one of two things will happen. Either already the rates that you get quoted on Earnest are lower than what you found elsewhere, and if that happens, then sign the loan, and once the money is dispersed, we pay you 2%. Option two is maybe Earnest didn't have the absolute lowest rate for you. If that happens, then all you have to do is email us at hello@joinjuno.com. Somebody on my team makes sure that you're comparing similar loans. So say you're comparing a 10-year fixed rate to another 10-year fixed rate. And as long as you are, then we work with Earnest to get them to change the rate on your loan to match the lower rate that you found somewhere else. And then instead of paying you 2% when your loan is dispersed, we pay you 3%. Hopefully that's a somewhat simple process. It all starts with shopping around, checking your rate on Earnest at the end. And if you need any help, emailing us at hello@joinjuno.com.
Oh,
A student does not need to sign up for a Juno account in addition to a parent. Either one of you can. What is important is as long as you just tell us what graduation year, so we know what deal to present you with.
and I just answered, but we can repeat it for other people. There was a question about if I'm shopping around, will my credit score be impacted every time that I apply for a loan? And the answer is actually no. The bureaus know, the credit bureaus know that, and that when they want to give people the opportunity to get rates and compare the rates. So the first time you apply for a loan and there's a hard credit check, yes, your credit score will be impacted, but then you have 30 days from then to apply to as many of the lenders as you want. They'll pull your credit score and your credit score won't be impacted all those other times. It will just be the first time, and then you have 30 days to go to apply to as many lenders as you want.
Exactly right. And thank you very much for that answer. It's really important because people are sometimes afraid to shop around.
Right.
Because they're assuming that it's going to harm their credit to check more than one place. Candidly, that's sometimes what other people want you to think.
Right.
Shop around and feel okay about it.
What's the points impact on a credit check by a lender? Well, that's a good question. I'm not quite sure I know that answer.
There's not an exact number that I can give you. There's a blog post on Experian that claims 10 to 15. But in reality, the amount that your score might be impacted by a hard check is impacted by the length of your credit history, the amount of recent checks you've had for non-student loan categories, and a bunch of other stuff.
So it might be different by each person.
Yeah.
And Stephanie's asking a good question. I'm not sure I know the answer to that. I could probably maybe ask some people, at lenders that we know. But since your credit is impacted the first time, how does that work with all the other lenders that now, when they pull your credit score, they're going to see the lower score from the first application?
That's a great question. It is sincerely a great question.
Yeah.
So here's what I would do. We've been talking about checking your rates using a soft check and a hard check a few times. If you are doing general rate shopping and you want to see what you might be eligible for, make sure you're doing a soft check. It'll be clear, like the text should be clear on whatever page it is. And in that case, it doesn't matter because it won't impact your credit. You can wait to do a hard check until you've received a soft quote that you're happy with, that you want to lock in. That might be the safer way to approach the process.
Margot has a question about, they have twins, and we hear this a lot about, should one parent be co-signing on both loans, or should they be splitting it between the parents?
That's a good question. Debbie, do you have an answer on that?
Yeah, it's going to depend a little bit on each parent and what their credit score is. But at some point, that one parent is not going to be able to co-sign for every one of if you've got twins, every one of the loans, because they might get tapped out. It's a good question. I would guess depends on what your credit score is versus your husband's. Because, you also might want to call and talk to the lender. And the reason why I'm bringing this up is because if one parent has a better credit score, maybe the first year that parent co-signs for both loans, but they might not be able to do that the second year. So you just might want to plan this out a little bit. I go back to my earlier suggestion about doing a 4-year plan, even more important when you've got twins. And if each one of them is going to have loans, and you have parents co-signing on 2 loans a year, you need to plan it out.
I think just to maybe touch on Stephanie's question again. So that's the scenario is you had fantastic credit, did a hard check, and then there was a big impact on your rate, on your credit score. So it's it's understandable if you haven't done a hard check for a long time, it's possible that it can impact your rate more than if you were more regularly using new credit. I know it's a little bit weird and counterintuitive, but it's possible that that's part of what's driving that. Now, it is true that when you're doing another hard check with another lender, they're going to take into consideration the reduced score that you have now after you did the last one. But if your rate, let's say if your credit score was already very high and it went down, it's quite possible that you're still qualifying for the lowest or among the lowest rates that are available from any private lender. Because if you had something close to perfect credit and you went down 50 points, candidly, for many lenders, you'd still be in their most competitive bucket of borrowers, if not maybe falling into the second most competitive bucket of borrowers who tend to get the lowest rates overall.
Okay, well, yep, Stephanie's saying no one has perfect credit. I spent months building it up, paying things off, and got it pretty high, and then I dropped back down. I hear you, but hopefully that first place that you applied to, even though you got hit, if you built up your credit, I'm hoping that you got the best rate that you could have from them. So Chris, somebody is asking, earlier they asked, should parent and student join Juno? But Alberta's just asking, can a student join on their own?
Yeah, either one of you can. No need for both people to join.
But but does the person who join need to be the person who's going to apply through your partner link?
No.
Okay.
Yeah, not at all. Good question. Yeah.
Okay, so somebody's asking, I'm still confused. Do we apply for a private loan every year for 4 years? It's my first child going to college. Yes.
Great question. For both federal loans and private loans, you apply each year. So there's 2 reasons. One, by law, you're only allowed to borrow up to the cost of attendance, and the cost of attendance that the school publishes is a number just for this current year. And second, even if you could borrow more for, let's say, multiple years up front, you wouldn't want to, because you start accruing interest on the loans once the money is sent to the school. And so if you borrowed for 4 years up front, you're going to be paying interest for on a much larger balance for a longer period of time than you need to. So really just for those 2 reasons, you want to make sure that you're only borrowing 1 year at a time.
And the only thing I will add to that, because there might be a little confusion, and I'm not going to name the lender, but I think that there might even be 2 lenders out there that are marketing a multi-year loan. And I will emphasize that it is a marketing package that they are putting out there. In theory, you are not borrowing the full amount for 4 years. They are not guaranteeing that you will get a loan every year for 4 years. What they are saying is that they are almost pre-approving you and saying, we think we'll be able to lend you like this amount for the full 4 years. And it is still a separate loan every 4 years. The only other thing as part of that marketing is that they may not do a hard credit pull every year. They may only do it the first year and then do soft credit pulls after that. But no matter how you slice or dice it, it's still 4 separate loans because the lender is going to want to give you a different interest rate every year.
Yeah, well said. So one more follow-up here, which is a loan dispersed per semester or the whole amount for the year at once? Fantastic question. When you do a loan application, you typically select whether you want the money for the fall, the spring, or the full academic year. Most of the time, people select full academic year. If you select full academic year, the amount you're borrowing is divided by the number of terms in that academic year. So if it's a semester system, half will be sent in the fall, half in the spring. If it's a quarter system, then the right portion will be sent each quarter. And that happens automatically in a conversation between the lender and the school. All right, maybe while we wait for maybe 1 or 2 questions to wrap it up, I'll give a really quick overview, which is, as I was mentioning earlier, I really hope people remember that if you do need student loans to pay for college, use the federal direct loan first. I have no incentive to say this. It simply just is true that the rates on that program are very low and the protections and the potential opportunities for forgiveness don't exist outside of this loan program. So if you do need money, make sure to use that first before looking at other loan options. If you need more than you can get to the federal direct loan, then that's when it makes sense to compare the cost of a Parent Plus loan to the private loan options that you might be eligible for based on your credit. And after you're done shopping around with other lenders, I would just ask that you'd consider checking your rates on Earnest through Juno's link and using our rate match program if you have found something that's better elsewhere. Mavin, another good question here. So the question is, when you borrow, does the money go directly to the school or can you get a loan for books, food, and other expenses? So the way it works is for both federal loans and private loans, whatever amount you borrow is first sent to the school. If the amount you've borrowed is more than tuition and fees, then that extra amount sits in an account that the school makes for you. And then you get to log into a portal where you can transfer the money to your personal bank account. So if you borrowed, let's say $30,000, I don't know why I keep picking on UCLA, but let's say it, and tuition was $20,000 for the fall, then $10,000 would be left over in an account that they'll set up, and you can just have that transferred directly to your personal account, and then you use it for personal expenses and housing.
So Chris, is one more interesting question. Actually, somebody sent it to me, and they're asking if somebody borrows, if a student borrows or a family borrows private loans, and each year they might borrow from a different lender because maybe they're a smart shopper and they want to shop every year, which they should, to see where they can get the best rates. So they might have 4 different lenders and with 4 different loans by the time that they graduate. Are they paying each lender back separately, or are there other options that they can do at that point?
Great question. So I'd say first, I love the premise because a lot of people will get a loan from one private lender 1 year and then not check if they qualify for a better rate from somebody else. So first off, kudos for even thinking about that. Second, The way that you can consolidate those different payments into one is through refinancing, which is simple, really just saying we're going to take out a new loan after graduation that pays off all of the old lenders, similar to a home refinance. And when you do that, you end up with a single payment that you have to make to one lender instead of 4 separate ones, so potentially 4 separate lenders.
So we didn't really talk about subsidized versus unsubsidized, but I know there have been a few questions about that. And basically, the quick answer is subsidized and unsubsidized only applies to the federal direct loans that we talked about earlier. The amount that 5,500 freshman year, 6,500, then 7,500 for junior and senior year. Those amounts can be split. And some of it can be offered as a subsidized loan versus an unsubsidized loan. That decision is made by the college. And it's a combination of the cost of attendance and how much, where you fall in terms of financial need. The college can then say, you can receive part of your student loan as subsidized and part as unsubsidized. And what that means is that on the subsidized amount, the government is paying your interest while you're in school. So basically, while you're in school, whatever, if you borrow that money, it's interest free to you. You do have to start paying back the interest after you graduate, but only the interest that starts accruing after you graduate. And you can also choose to only take your subsidized portion and not the unsubsidized. So so it all depends on your particular situation about what you've been offered and how much you need to borrow. But absolutely, again, kind of based on everything we've been talking about tonight, if you have to borrow, you should borrow from the federal student loans first. And then of those loans, you should absolutely borrow the subsidized and then go to the unsubsidized.
Great final question here from Kay, which is, so what happens if your kids are going to grad school? And that's a great question because that's why Juno started in the first place, actually. So the quick context is that start with the answer and then let's go to context. If your children are going to grad school, Juno has fantastic options available for them. We started in the graduate student space. Almost all of our employees have used Juno for grad school loans. So you can just tell them to sign up at joinjuno.com and or book time with us, and we can walk you through everything there is to know about grad student loans. At a really high level, grad student loans from the federal government are priced the same as the Parent Plus loan program that we showed you. So if your child's going to grad school, they pay the 8.05% plus the 4% origination fee. But a lot of grad students end up qualifying for cheaper private rates than what they get through Grad Plus and choose to use the private options. We'd be more than happy to walk somebody through that. Rashmi is asking if these loans are insured in any way in case of an unforeseen situation. So at this point, most loans have death or disability release. Not all, but most. So if you have a federal loan or a private student loan from many of the largest lenders, if the borrower, say, unfortunately passes or has a permanent disability after borrowing, then it's possible to completely discharge the loan amount, meaning it's wiped away and forgotten about.
Good question. Kay's asking if the graduate student of the loan for graduate school, does it go through the student or the parent?
So for grad school loans, if you have credit history, and especially if you've been working for longer than a year, then it's possible to get a grad school loan from a private lender without a cosigner. if you don't have any credit history, then I'd recommend using the Grad Plus loan. So it's, as I was saying, similar to that Parent Plus we spoke about, and you can qualify for that without having any credit history and without involving your parent.
So I think this was great, Chris. Thanks for all of your information. Hopefully, I think we answered a lot of good questions. Okay, one last one. Sorry. Do Texans have to shop around, or can they reach out directly to Brazos? I'm assuming.
Reach out to us directly, or if you make an account on joinjuno.com and you enter that your state of residence is Texas, we will automatically branch you to a special relationship we set up with Brazos. I don't want to speak too uniformly, but I'd say you don't need to shop around much if you qualify for the Brazos rates, because as I was saying, as of this morning, the lowest rate you can get is 2.77, and the highest,
which is really pretty amazing in this interest rate environment.
It is truly amazing.
It really is
possible because they're a nonprofit state lender.
So if you can take advantage of that deal, if you are a Texas resident or your students going to school in Texas, it seems like a no-brainer.
Yep. So yeah, just if you have a Texas ID and you're going to college outside of Texas, you can use it. Or if you are from any other state and you're going to college in Texas, starting next week, you can use it.
Yes, and to confirm, Stephanie's asking, and I actually confirmed this with Chris before we got on, but if you're a Texas resident, you can use Brazos wherever your student's going to go to school, whether it's in-state or out-of-state. And then if you're an out-of-state resident, it can only be used for out-of-state residents going to school within Texas.
Yeah. Wonderful.
Great.
All right.
Okay. Well, thank you, Chris. Thanks everybody for staying on. And I'll just throw this out. If you have more questions, you can, reach out to Juno, but we're also going to do an AMA and Ask Us Anything on Monday. So if you spend time over the weekend and do some more research and you come up with questions, we're going to do that as as another Zoom, and also you'll see it on Facebook, but just know that you can come ask questions at that as well.
Thank you very much for hosting this, Debbie. Thank you everybody for all of the fantastic questions. And yeah, if you have any questions that we haven't been able to answer, please know you can always reach out to hello@joinjuno.com and somebody on my team will get back to you same day.
One last quick question, Chris. Somebody's asking, how long do you think it takes to get approved by Brazos?
Typically 2 or 3 days, but it can vary depending on how simple, let's say, it is to verify your income. So similar to other lenders from what we've seen.
Okay. Good night, everyone. And hopefully you got good information. I'm assuming, honestly, the next 3 weeks are kind of the busiest times about figuring out these loans. So again, if you have questions, feel free to reach out. Take care.
Yeah. All right.